aggressive portfolio for someone in their 20s or 30s is, of course, going to be a much better fit than it is for someone that's in their, 50s, 60s, or 70s. I still, to this day, clients ask me what the key is to really getting ahead. And the best thing that I ever did was every month on the 15th, my account gets debited, goes straight into a diversified portfolio of shares. I rarely look at it. Times like these, I celebrate because I'm buying the same thing that I was buying last year, but I'm now getting more units every month because I'm buying at a 20% discount. So, it's a strange thing to think about, but for my clients that are accumulating, and superannuation is a big part of that, because really the vast majority of people are employees. They don't have a choice with regard to superannuation. So that money is always going to be going in. So realistically, volatility is your friend, because you're buying the same asset month after month or quarter after quarter, depending on when your employer is putting that money in, and you're getting it on a sale price. Whereas if you're on the opposite end of the spectrum, where you're not adding money to your investments, you may be retired, you're pulling money out. You don't want to see volatility. You want to see a straight line where the value of your assets are only going up because you're constantly pulling money out. So I think it's, it's very much horses for courses, where everything that is done needs to be bespoke for you, your circumstances, what stage of life you're in. An aggressive portfolio for someone in their 20s or 30s is, of course, going to be a much better fit than it is for someone that's in their 50s, 60s, or 70s. So again, it's very much circumstantial, and it's objective based as well. I mean, if you have, let's say I had a large windfall, I go and win the lotto, and I need a 2% return to fund the income I need forevermore. I mean, really, even though that it's going to provide me with the best outcome, I probably wouldn't go and invest it the way I have now to get 10%, because I don't need to. But then, and it's the other side of the coin. If someone's got $100,000, they want $10,000 of income a year. They're not going to get that unless they're sitting aggressively in growth assets. So it's just about weighing up that risk return versus your own personal circumstances and what it is that you're trying to achieve there.